There are two things that I do not look forward to each year: taking down and storing the Christmas decorations and paying taxes. Can you relate? Welcome to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser. In today's episode, I wanted to bring on a partner of ours who helps our advisors implement strategies to help customers leverage their money while doing so in the most tax efficient way. Our guest today is Jeremy Bickler of NIW within our Simplicity family. And many know from our previous episode last year, episode 34, if you check that out. If not, make sure to tune in. It's been over a year now since we had Jeremy on. So how are we doing today, Jeremy?
I'm doing well, doing very well. Thank you for having me, Jeremy.
Isn't that weird saying your own name?
It is. You start to think you're talking in the third person. So it's a challenge.
All good. So kicking it off, like I mentioned, we did an episode about a year ago. Y'all are brand new to Simplicity, and now fast forward, here we are today. So I want to do a quick little recap. So how was 2023? So the listener knows a little bit more about NIW. You guys are also the ones that are utilizing Kaizen for life insurance. So how was 2023 for our partners at Kaizen?
Uh, 2023 had some headwinds, Jeremy, because obviously we're borrowing money, right? By nature, we utilize leveraged life insurance plans. So number one, we had all the Fed rate hikes, multiple Fed rate hikes. So in the short term, while you're borrowing money on paper, it makes it look a little more challenging. You're not leveraging as much of the upside. Now, along with the rate hikes, of course, you have cap increases, but there's a lag there. So the borrowing rates will rise faster than the carrier cap rate. So we had those challenges, along with, of course, the regulations came in and we had another AG 49 implementation. So mind you, the overall outlook long term, which these things are marathons, not sprints, of course, we are not concerned about. But in the short term, there was that compression where the upside is not illustrated. And just by nature, there's a human nature component to, especially financial, right? When they don't look as good on paper. So we had that. But largely 2023 for NIW was a success. It was very exciting because, as you mentioned, we were acquired as of last year. So it's January now. It's been a year. We have implemented almost all of the Simplicity shops have taken this on, which that was very, very exciting. Our traditional finance business and our Kaizen business, stayed strong. We finished very strong, finished out the pipeline in December. So all in all, as far as the finance industry goes and leveraged life insurance, we had a very good year considering those headwinds that we had.
That's awesome. That's awesome. And so since it's been about a year since and you mentioned several things that happened in 2023. So as we sit today, what would you say is the biggest difference when we talked last January compared to today, when you look at Kaizen and the solutions that you guys offer to our advisors?
Yeah, so the tech platform, and I think we can get into that a little more in the call, continues to improve. ILIA, which is our acronym for Interactive Learning Information Assistant, continues to improve and be more robust with the training, presentations, the capabilities inside of ILIA that we have there. That continues to improve. And plus, I mentioned all of the partners we brought on now are all just going past the implementation phase. So we're extremely excited about that. And the other one that is huge right now, that this is brand new, Jeremy, inside of the last month, is one of our carriers has now approved monthly. So client contributions. So
and just in case for those users or those people that are listening, so that is a pretty big deal, especially for what the amount of money policies traditionally have with this. So can you talk a little bit about that first before going into what you were talking to or where you're going?
Exactly. So here's an example. The overall annual minimums did not change. Say you have a client putting 24,000 a year in, which is kind of an average Kaizen case. The client used to, up until this new implementation, you had to put 24,000. There was no annual or monthly contribution available. And sometimes with budget constraints, even if you're a high net worth client, or especially in an executive bonus scenario where you have the employer bonusing the money, just from a budget perspective, it may make sense to be able to do that monthly. We can now do that. So you could open a Kaizen for $2,000 a month, $1,700 a month, depending on your age. And again, this implementation is literally in the last 3 or 4 weeks. Very exciting. We're already bringing cases in. So that is one of the big things from an opportunity standpoint for agents as well that are providing these type of solutions to their clients to look forward to in 24.
That's awesome. And so you mentioned tech, so we'll stay on that for a brief little second here. So what are some of the best practices you said right now, fast forward for a year now, implementing across the platform? So what are some of the best practices you've seen that some of the groups who are new to Kaizen over the last 12 months, where are they having the most success as advisors implementing the tech into their practice?
Yeah, so with our tech platform, you can enroll your clients 100% online, 100% paperless. So from a marketing standpoint, you can give the presentation, even if you're doing what you and I are doing here right now, Jeremy, or whether they're in your office. One of the things we have found out post-pandemic, and I don't care if it's Harvard Business Review, Insurance Newsnet that does these consumer reviews, 90% of due diligence is being done online right now. And this is across generations. I don't care if we're talking about Gen X, millennials, even boomers, right? So when you get done with that call as an advisor, chances are your client is going to Google you, or they're going to Google premium finance and go down that rabbit hole. So what that platform really allows you to do is invite the client into, have them do the education themselves on their terms, and then you are more of a steward through the process with that. So we have seen agents implement this into their process without feeling like they have to, it's in addition to, not instead of. Okay, I'm a successful annuity guy, or I'm already successful doing this. I'm an AUM guy, for an example. I don't feel like I'm neglecting the other parts of my practice because the tech side of the platform. So as far as the implementation, the tech has allowed them to bring that on without doing too many of their resources or straying from where they're already successful from that standpoint. As far as the who, Jeremy, we're still seeing a lot of clients-wise, business owners, as an example, physicians. We're seeing a lot of those standpoints. I brought up the executive bonus solutions for key employee type individuals wanting to, carve out and not have this typical safe harbor rules where you're offering it to everybody. I just want to come in and do this for a choice few people that are key to my business. We're seeing a lot of that as a executive bonus type or an executive benefit type strategy.
What's usually the size of the companies you see as a sweet spot that you've seen? I mean, is it, how many employees, and then how many typically, is there a common theme?
Yeah. We get scenarios across the board. But if I'm looking at volume, you're probably seeing employees in that 30 to 100 type more, where it could be the owners themselves doing it on themselves, which is very common, or the owner doing it on a few key non-owners. With that being said, I'm going to talk out both sides of my mouth here a little bit. We do very large multi-life scenarios where we'll come in, large investment bank, for example, wanting to carve out 300 to 400 of their top people that are on path to partnership and offer this as an executive bonus. When you're able to not just bonus somebody, but leverage 3 to 1 on top of that, it can be a very compelling retain and reward tool for some of these businesses. So we get the large ones, a little more few and far between, but in that 30 to 100 type employees is maybe the mean or the average.
No, that's good stuff. So retaining top talent. And so what has you optimistic here for 2024? So it seemed last year, a lot of systems, processes, working out some of the kinks, interest rate environment. So here we sit looking forward in this year. So what's the outlook look like for you guys?
Absolutely. Great question. So number one, we are very excited about 24 for all the reasons I mentioned. The other thing I brought up the headwinds we were facing in 23. Well, we truly feel we're going to be going in the opposite direction. Now, our crystal ball is no better than anybody else's, but many of the pundits, the experts feel we are going to start to experience Fed rate drops. Now, does that mean it maybe won't be till Q2 or June? You're also, as testament to this, Jeremy, you're seeing people are hedging treasuries left and right now, which again, in anticipation of some of these Fed drops. So number one, we think we're going to get some relief there, which again helps even in the short term. We're also very excited about our couple key carrier partners that have talked about enhancements to their products. You're going to continue to see caps increase because through all of this, the carriers have been investing at higher rates. You're seeing fixed accounts now even north of 5, right? So that is going to continue. So we're very optimistic about that. Again, we brought up the monthly previously. That's going to be a big one. Further tech enhancements. The other thing we're going to be doing as well, and there's a few things to be determined, specific dates, but we're going to be doing some boot camps. We're going to continue to partner with organizations like InsurMark to continue this education that we have going forward to help these advisors implement this strategy.
I love that. And most people that listen to this show, so a lot of them maybe listen to this and it's been a year. And so everybody doesn't jump in at first, but over time. So as getting around a lot of top advisors, you're with us in Nashville. So there's some buzz around having conversations about not just life insurance, but also Kaizen. And so for the advisor who's looking to maybe, just maybe utilize the Kaizen process and do one of their first policies, what is an ideal person? Like how do they start? What's the process? What do you see is the best way to at least get into the water?
Yeah. So I'll talk about from a qualification standpoint. Technically, you can write at ages 18 to 60. Now, there's a wait time to let these cook before we pay the lender back and you can start an income stream. So the wheelhouse, Jeremy, that we see from volume applications daily is typically ages 35 to 55, people with discretionary income. So the carriers have guidelines. They vary a little bit, but I'll paraphrase. And again, they're the carriers' guidelines, not ours. When you have minimums around, 21 grand a year, even if you can pay monthly, you're talking about clients that the family household income is 150 to 200,000 as a minimum, right? Even from a straight suitability standpoint, can they afford these premiums? So that's a very typical scenario where household income of a couple 100,000, concerned about taxes. I've got discretionary income. I love the concept of a Roth IRA, knowing that I'm not going to necessarily get the write-off today, but I've got the tax advantages on the back end. I mentioned business owners as a huge scenario there. Physicians, tech industry, that's where we're seeing a lot of the business. Even this is a little more niche, but semi-professional and professional athletes, because there's only 5 Kaizen payments. Remember that is something that is the same, and regardless of your age, regardless of the design, the client contribution is only 5 years. And we're going to leverage on top of it from there.
And you may not know this, but I had a call in January on our mastermind call, and one of the advisors, he was actually with us. He was actually with us in Nashville, and one of the things that was interesting on the call is a couple of the advisors were mentioning that they're already in underwriting on themselves. One of them actually, he just finished his 5th payment. So he talked about how it's more of a just like, whew, like it's a relief to now. It's like, all right, let's see how this thing goes moving forward. So it's like all types of the spectrum. And so I'm trying to talk wide, but also narrow in too, because a lot of the advisors that may listen to this, they may have just a bad taste in their mouth with underwriting, or life insurance is just not their cup of tea. They really utilize a lot more annuities. Maybe they do assets under management annuities. So for that advisor, what advice is there for why they should consider looking in, or what's a best practice to do to Like where's the system, the process that could be a benefit to them who's not really interested in life insurance in the past, but moving forward in 2024 on, why this should be a huge opportunity for them?
Yeah. So I mentioned Illy a few times now. That is going to be your biggest asset and friend in implementation in terms of reaching the masses, however wide of a net you end up wanting to cast.
Hmm.
That is going to be the biggest one. And it's more importantly, Jeremy, going to help you not overcomplicate this, because at the end of the day, it still is a max funded IUL. We're putting some guardrails in there to increase predictability and, more importantly, decrease the client's exposure. I'm glad you brought up for advisors that are in the senior market. You heard me say 35 to 55 is kind of the
Hmm.
wheelhouse. Well, on its surface, you may feel that, well, that kind of takes them out. Well, another thing we're very, very excited about in 24 that we have seen advisors that typically specialize in the senior market excel is we have a great wealth transfer program. It's a gifting strategy. So let's rewind, Jeremy, about 18 months or so. And I brought up those qualifications. Remember, a couple 100,000 of household income. We would get clients coming to us as my 65-year-old client or my 60-year-old client has a 25-year-old son, has a 30-year-old daughter that doesn't qualify for Kaizen because they make like 75 grand a year. I want to gift them the premiums, the 5 premiums, because I believe in this. Could we do that? Rewinding back 18 months, 2 years, the short answer was no. Unfortunately, each individual insured has to apply per the guidelines. Not the case anymore. We have both carriers on board. So now if you have that scenario, if you are in the senior market and you have a higher net worth client who is talking about perhaps spending down, leaving a bigger legacy. So instead of leaving just that liquid asset, how about you gift the premiums, lock up someone's insurability, give them $1 million to $2 million of death benefit, give them tax deferred growth above a fixed rate of the return, all the things we know about indexing, and more importantly, tax advantaged income stream through policy loans down the road. So much more conducive and efficient use of your money if that is an option. So we're seeing a lot of that right now. That is another thing that has kind of gave us that strong finish to 2023 heading into that. And we are seeing more the IMOs that are heavy on annuities, as well as the advisors that would normally specialize in the market. Where on its surface, you wouldn't think this would be a leveraged life insurance sale, talking to them about their beneficiaries and their loved ones. The only thing caveat to that, Jeremy, is it is adult children, because these are trust owned. Okay. And if you're a minor, you can't be a settler of a trust if you're under 18. So we're talking, when I bring up your children or your grandchildren, it's adult grandchildren. So, got it. And this is stuff we can do, your team and bringing my team in, if an advisor has specifics, because there is guidelines for this from an implementation standpoint. But that is one thing, if you are in that market, I would really consider, because that has taken off.
I think, sorry about that. And I think, no, that's actually an incredible opportunity. I didn't even think of that. And you mentioned your team. So let's talk a little bit about your team. So working with you guys. So obviously you guys are on applications with the advisor as well. So can you talk about maybe the 3 things advisors get with your team when they're moving forward with this process?
Absolutely. So first, when you partner with us, when you have a case, we're going to provide you that tech platform. First and foremost is going to be your home for everything from training, marketing materials, again, client education, enrolling your clients. That is one of the things we provide. There's no charge for that. Even the DocuSign fees within that, because it's 100% paperless, there is no cost for the advisors. We're not taking a higher split for that. That is something that we have implemented, that you have available to you as an advisor partnering with InsurMark and NIW. The other thing we're going to do is we're going to do the designs on the front end without getting into the weeds, Jeremy. Right. Our IUL designs are yes, they're max funded IUL, but we start from a position of underperformance, meaning we're going to take the two worst conditions, 15-year periods the market has ever seen. That's Great Depression era for market returns and 1980s interest rates, double-digit borrowing rates. And we're going to make sure the design is pliable through both of those. So know on the front end, we're doing the diligence in the design, again, to create that and make sure that design is resilient with whatever carrier of the main two that you wish to do. And finally, and I'm going to steal a quote from one of the founders of NIW here, Dane Wimwell, is do not underestimate the power of service when it comes to mitigating risk. So once the case is in force, as your partner, we are the plan administrator. So we are there for 15 years until that lender gets paid back of loan service. So annual low point letters. If we need to refinance in year 3 or year 5, we're going to do that. We're going to do further cost mitigations after year 10. Maybe for some reason, the advisor is not even around or has a relationship with that client anymore. We are on the hook and are going to be there for that 15 years. So those are the main 3 things is we are to and through a third-party administrator along with you to help you get this thing to what is ultimately success, which is paying the lender back and getting to that income stream your client is looking for down the road.
That is powerful. And we talk on the show a lot about systems, processes, and really the theme of the last, I'd say, quarter has been 10Xing your business and getting the right mindset and focusing on really the main drivers of your business and the concept of being able to delegate the things you're not necessarily good at. And you guys seem to have a proven system process that advisors can plug into. It just makes sense to have and utilize a service like this to delegate or at least give it a shot. So that's you actually articulated really well. I know it's been about a year since the last time we spoke. The first time we were speaking, my eyes were crossing because it was so over my head. But I probably relate to my advisors that are listening because now hearing it now a year later, I think it's all starting to kind of come together. So as we're wrapping up, is there any last words or any wisdom, anything you'd like to share? Do we miss anything?
No, that is about it. Again, just from an opportunity standpoint, allow us as your partners along with InsurMark to help you with the implementation to where it's not too overwhelming. You're not forced to overcomplicate it. And you're simply bringing on a new strategy to help as far as solutions based. We're not promoting anything. You're taking the client's information in as you do and providing solutions. And you're just adding this as a solution to what you are already providing to another client. So looking forward to 24, Jeremy. Very much.
Looking forward to it. I'm pretty optimistic about this year and the partnership here with you guys. So thank you very much, Jeremy, for taking time out and joining us today, obviously. So, and also thank you to the listener for tuning in. Make sure to subscribe on your favorite listening device so you do not miss out on any future episodes of the Advisor Mentorship Podcast. Also follow us on LinkedIn. And as we sign off, remember, in a world full of betas, be an alpha.